All right. It is our much anticipated 2026 predictions episode. We're laughing because obviously with being in the industry and in the market and everything, we do feel the need to kind of like call our shot a little bit, and based off of what we're seeing, what we think we will see. But with that being said, we do get a kick out of obviously 365-ish days later, listening to these again and being like, well,
that wasn't quite it.
Yeah, we recorded a podcast. But no, I think there was some stuff that we were pretty close to right on with the last ones. Obviously, we did that 2025 year in review. And we're going to do it again for this one. So let's talk rates first. I think that's a natural segue. We typically start. Maybe before we do that, I'll kind of share, as always, guys, that this podcast is for informational purposes only. Doesn't constitute any legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. Smash subscribe button. But yeah, Cole, take it away. Let's do it.
All right, so Austin wants to talk rates, and you know me, guys, I love rates. That's my whole life.
Talking rates.
That's all we talk about. So as always, there's variable, there's fixed rates. Variable rates, as everybody knows, are driven by the Bank of Canada. Whatever the Bank of Canada does is going to directly impact variable rates. So let's actually start there, Austin. We saw a number of rate cuts over the last 2 years now. And we just had an announcement that we haven't really spoken about, but we had an announcement this week, and as of recording this, no surprise, the Bank of Canada didn't do anything. But that's not why we're here today. So what do we think the Bank of Canada is going to do in 2026? And I'm just going to come out right away and say, I'm anticipating that we're going to see one more rate cut before April of 2026. I think we'll see one more quarter point rate cut before April of 2026. And I don't think it's going to be more than that, which might be a bit of a bold prediction. And here's why. Because Austin and I have said this before, is the Bank of Canada typically likes to do things in more than one iteration. So if they're going to make a rate cut, they're probably going to make more than one. In 2025, for example, they made back-to-back rate cuts on 2 different occasions. So I think they might only do one in this case. I think we might only see another quarter point. And I think that's going to happen probably not till closer to April, like March, if I had to guess. But I have a feeling we might only see one more by that time. And then by the end of the year, I wouldn't be surprised if we are either at that rate. So let's say we're down another quarter point, or we're even, who knows, maybe we see another rate boost a little bit. So maybe we end up having a rate drop, and then later in the year rates go up a little bit. So my prediction by the end of next year is that rates will be at, I believe we're at 2.25% right now. So I think we'll probably be at 2. Let's say we'll be at 2% on the what's called the overnight rate by the Bank of Canada by the end of next year. That's my prediction right there. Austin?
Sweet. I don't have as much informed.
So you're just going to guess.
Yeah, I don't necessarily just want to say something and then be like, I have to stick to this for all of 2026 for the sake of it. Sure. Do I think that you bring up some interesting points? Yes, I do. Would I be surprised if that's what happened? No, I think everything plan-wise that you've articulated makes a ton of sense. The only thing that I am looking at that could throw a wrench in that would be, only thing, that's loaded. Obviously, July is the trade agreement renegotiation.
Yes.
I think that, if something funky happens, and it could, we get thrown curveballs, I feel like, bi-weekly on this show. So, something funky goes there, I think that could, drastically change rates. So if tariffs come in or the trade agreement changes substantially, whatever, could the Bank of Canada, for the sake of affordability, feel the need to, dump rates further than that? Maybe, who knows? But that's just something that comes to mind as you're talking through that. So yeah, do you have anything to add on that, Cole?
Not really. That's a good point, Austin. I think that's definitely a possibility. I think the only thing I would add is that this is an ongoing thing as data comes out. And the big data points we're talking about here are inflation, we're talking about the job market, and we're talking about the Canadian economy, so GDP. So when we get those values, or when we get that information, that's a large part of what drives these decisions. And on a monthly basis, we're getting inflation data, we're getting unemployment data, quarterly, we're getting GDP data. So these types of things are going to impact what's happening in the economy ultimately and what's happening in the rate market. So the Bank of Canada is going to continue to try to keep inflation around 2 or 3%, and they're not going to make adjustments unless they feel like it's absolutely necessary to do so. That's why it's fair to say that rates from a variable perspective are probably going to be similar at the end of next year than they are now, assuming the Bank of Canada doesn't do a lot of things. Okay, so let's transition now into fixed rates. And again, it's hard for me to put Austin on the spot here, but what I will do is I'll give some context to what's happened recently. So fixed rates have actually gone up a little bit in the last week, and that's because the bond market responded to unexpected success, maybe that's not the right word, unexpected growth in the job market as well as unexpected growth in the economy. So we talked about this on one of the more recent episodes that the Canadian economy did a heck of a lot better than expected in Q3, and we created a heck of a lot more jobs than we were expecting. Now, what's not obvious to everybody is that GDP growth was largely due to government spending on warships, essentially. And then the other aspect of that is the job market did see some growth, but part of that was part-time jobs for people in the, I believe, like younger demographics. So yes, we're creating jobs, but part-time jobs aren't necessarily what's going to help the economy continue to grow. So the bond market still responded to that. And we saw, like I said, fixed rates come up a little bit. Fixed rates are sitting kind of right around the high 3s to low 4s right now. That's a very general way to put it. That's going to depend always on your specific circumstances, but that's kind of where rates are sitting. So if we took the middle of that, let's say 4% is where rates are at, that's a pretty reasonable number to expect for rates to continue to be at, in my opinion. I don't think we're going to see rates come below 3%, and I don't think we'll see rates go above 5% again, because in the short term, that is, unless dramatic things happen. So 4% seems like a very reasonable place to be. So I don't really have any bold predictions when it comes to fixed rates. I think we'll see some ups and downs throughout 2026. But again, don't be surprised if rates are sitting within a 0.5 percentage point of where they are right now. And barring anything drastic, of course. Austin, again, I'll throw this over to you. I don't know how much input you want to give on this because you're kind of playing with no ammunition here, but
can you imagine I've got takes on fixed rates? No. No, everything you've laid out, I've been kind of watching the bond market as well. Definitely interesting. Yeah. Everything that you said about, where fixed rates will probably be. Yeah. I think that they'll kind of sit between 3.5% and 4%, depending on how long, could they creep just above 4? Yeah. We always talk about how fixed versus variable is kind of a personality. Can I ask you as well, what is variable sitting at right now then, roughly?
So variable, your best rates are right around 3 3/4, maybe like 3, maybe you'll get as low as 3.5, but let's say 3 3/4 on the better part. And then best rates fixed, it depends a little bit, but you're probably a bit higher than that. You're probably closer to the 4% mark. So there's probably, let's say, a 1/4 point spread between the two right now, where variables outperforming fixed. If you took the exact same product and you had to choose one or the other, you would do a little bit better on variable in most cases.
And is that, not to go in the weeds here, is that for insured or uninsured?
So that's kind of across the board. That's why I'm trying to give you like kind of a general answer.
Cool. Gotcha.
Like insured for like the lower rates, because you're always going to get lower rates for insured, but like that spread is pretty consistent across the board. It gets a little bit tighter in certain circumstances, but in general, right now, variable is going to outperform fixed with select special occasions, let's say.
Yeah, I think the way, and this is just my opinion, I don't think where rates are right now, I don't think that is a reason not to like get into the market or buy a place. Like I don't think those changes are that substantial. Like even a 1/4 point drop on a variable, assuming you took variable, is going to be probably $9 to $13 per 100 grand. So that would save you like
Good
on a
guess,
400 grand mortgage, probably save you $50 a month. I don't know if $50 a month is a reason not to buy a home if every other part of your criteria makes sense, whether that be like what you're looking for, the area, assuming that the mortgage makes sense for you. I don't think that that's a reason not to buy a place, $50 a month. But that's just my opinion. So yeah, I think all of that makes sense.
Yeah, exactly. And I think one last thing I'll touch on here for rates before we jump to our next prediction is variable rates tend to outperform fixed rates historically. Austin and I have talked about this many times, and at this current moment, we're kind of back in line with that. For a long time, we didn't, or not for a long time, but for the last, let's say, year to 2 years, we saw the opposite of that. We saw a bit of an anomaly. But if we look back far enough, it's very predictable that variable rates are going to outperform fixed rates, if not necessarily by a lot, but even like I said, right now in some cases we're looking at a quarter point roughly. That's what's expected. Like that is what we would assume is going to continue. Now we are expecting things will kind of move in both regards. Fixed and variable will move a little bit, but it's very common that variable rates will do a little bit better than fixed rates. And that's why variable rates have been a choice for a lot of people for a long time. I've spoken to many people that they will only go variable because they know over a long enough time horizon, they're probably going to do better by choosing that. And again, they're happy with that. They're fine with the additional risk that comes with that, but that's just one point I really want to make here is that we're back to a point where rates are what would be expected in terms of what the spread is between variable and fixed.
Yeah, I think that's very well said. Obviously, there were some circumstances, in my opinion, where fixed made a ton of sense. Like when you were seeing rates in the the 1.6s or the 2s, like that made some sense to lock in for. But I don't think we'll ever see that again. So if you're interested in taking those rates, maybe get a time machine and go back to 2020. Okay, let's talk about the market and where it's going. And I've got the stats for this year kind of pulled up. And what will we see in 2026? So this year was really interesting. January, February, March, we felt a fairly strong market. We saw HPI price go up. We saw pretty decent turnover on listings. Like as long as you were priced right, marketed well, and listed where you should be, you weren't chasing a crazy number, you were probably going to get a bite. You were probably going to get a sale. Like when I look at sales to active ratio in earlier this year, yeah, you were sitting up in the 10, 11-ish%. Became maybe not as strong, but we still saw some prices going up. So January 10, February 9.8, March 10.3, saw things dip in April. And I think that's also when all of the tariff stuff really started to take effect and in the media and everything. And we kind of saw confidence in the market, I think was challenged quite a bit. And then we started to see HPI price and sales and listings pile up, and we started to see prices kind of definitely dip from that point. So from where we're sitting at today, we don't have the December stats. My hope is that we are sitting here 365 days and we're sitting around that same number. I know that doesn't sound super sexy, like, oh, we're not going up by 3, 4, 5% or down 3, 4, 5%. I think January, February, March, historically, we do see a bit of a bump in the market, people deciding to, hey, this is the year I got to make a move. This is the time, this is the year that I get into the market. And you see a little bit of drive and you see a little bit of motivation for people wanting to do that. And I think that will help the market move along a little bit. What I also think, though, is that we're still sitting with, quite high active listings as much as we've seen them come down a little bit. Over the last couple months. That's also seasonal. I think we'll see listings pile up a little bit. So, that increase in activity balanced out by the increase in listings that I think that we'll see, all of those things being considered, I think flat would be a great goal for this year, barring some other changes and some other data and some other news. My hot take is that by the end of the year, if we're within like 1 or 2% of where we were last year, I think that's a pretty strong year.
I think so too. I think that's a pretty solid trend. I mean, we've been trending down price wise in the last number of months.
Yeah.
I think a lot of homeowners would be okay with their prices remaining pretty strong and staying where they are. And I also think that Austin's absolutely right. It's very possible that we'll see a bit of a push at the start of the year like we did last year, and we'll see a push from the buying side, but we'll also see people getting back to listing their places. We talked about this on a recent episode where in December, people tend to kind of pump the brakes a little bit and they're like, okay, well, why would I list now when I can just list in the new year when people are actually getting back into the market from a buying perspective? So I wouldn't be surprised if those things go hand in hand, where we'll see some more buying activity, but with that, we'll also see some more selling activity. And it just really comes down to, is there enough buying pressure that's going to start eating up some of that inventory? I don't know. Nothing's pointing towards that right now, because it tends to be more of a crowd mentality when it comes to buying, and seeing that upward pressure is, as more people buy, more people tend to want to then follow suit and do the same thing. And there's nothing pointing towards that right now. We've seen, as we just talked about, we've seen rates come down to what I think is now a pretty steady level of where rates will likely remain. And I also think that we've had talks about, hey, rate cuts are happening. That's going to get more buyers in the market. And at the end of the day, I think people are weary about the economy as a whole. I think they've seen, like I just said, prices come down a little bit, and everybody's trying to time the market because they think they're experts, and they want to buy at the bottom and they want to sell at the top, right? And I understand that, but at the end of the day, like, if it's the right time for you, it's the right time for you. But that's not the point here. The point here is I don't see enough momentum to see a dramatic shift in the market. And I think, as Austin alluded to earlier, is there's still a lot of uncertainty with trade, which is a huge part of the Canadian economy. And I think that that's going to still cause people to remain cautious about making that jump. And I also think that we saw prices at a pretty high level, and there's people that bought at that time and they've seen their property values decrease, and the people that aren't in the market are like, well, I don't want to be in that same boat. I don't want to be the one that buys now and then 3 years from now my property's worth less than I paid for it. So it's fear. It's not enough people in the same mentality that's going to push the needle and kind of make things happen in terms of the market to eat up some of that inventory. So I think Austin's prediction is honestly bang on in terms of it's more or less might look the same. And I think it would be positive if things remain fairly steady throughout the year. And we're obviously going to see ups and downs, but I would love to sit here and say, or stand here actually and say, yeah, the market's going to take off. We're going to see properties increase in value every month over month. Every stats episode Austin and I put out, we're going to be getting a little bit more giddy with every one, because we're seeing prices go up and we're seeing volume, or we're seeing transactions go up. That's unrealistic at this point. There's nothing to suggest that that's going to happen. But you know what? I'd really like to be wrong about that. That's one thing I'm okay with recording this episode next year and Austin and I putting our tail between our legs and saying, you know what? We were wrong. The market did amazing this year. I think, Austin, I speak for you when I say that would be something we're happy to admit that we were wrong about.
Yeah, no. And I think, again, we have to look at the data. We have to look at what's in front of us. And for all we know, the goalpost change, something comes out, a month or two into the year and gives people a lot of confidence in the market. Maybe that is they figure out a tariff solution, they renegotiate something. Maybe there's something that goes on federally. Who knows? That stuff is all beyond our control. But just with the data that we have, again, I think it just comes down to supply and demand. I think you're seeing a little bit more, like for sure more. I shouldn't even say a little bit more. You're definitely seeing some more confidence from first-time home buyers. They're starting to eat up some of that condo entry-level inventory. You're going to see those people then be able to move to something else. So again, all it takes is that little bit of a trickle, and you can slowly pick away at that inventory. That's kind of the episode that we've got. Anything else that you want to add, Cole?
For sure. I think one thing that's still worth noting, and I don't know if we talked about this on last year's episode, is we're still dealing, at least from my perspective, we're still dealing with a lot of people coming up for renewal in 2026. So there's going to be a lot of people that took a 5-year in 2021 at, as Austin said, pretty good rates, right? Like, if not 1.5%, we're still talking in the 2s, even low 3%, which Now, a low 3% compared to what you can get now is not as much of a difference. But if you're dealing with, let's say, a 2% rate and now you're getting a 4% rate, that's double. That's easy math, right? That's twice the amount of interest that you're paying on that loan. And that can be hard for some people to qualify. So that's going to be an interesting thing to see this year. I'm not overly concerned about it because I think we've already seen a lot of people come through the renewal cycle in the last year or two, and they've been having to renew at even higher rates. And we haven't seen anything concerning in terms of people being unable to qualify or being forced to sell their homes. Like, yes, that happens in some cases, don't get me wrong, but it hasn't gotten to a level where it's cause major concern in the market or it's causing financial institutions to have any problems. Because I mean, that's when things can get really ugly, is when financial institutions start having major problems with the loans and people stop paying those loans. Things can get a little bit ugly. So I think it's worth keeping an eye on, Austin, but I don't think it's a major concern given that rates are now at a reasonable level and they'll be dealing with a little bit of sticker shock for sure, right? Their payments might go up, but as I've mentioned many times, there's always ways to try to stretch out your mortgage a little bit longer to get those payments down, or different strategies that you can use to try to keep your payment at a manageable level. Or in some cases, you gotta make some life changes because now your payments are a little bit higher and you can't afford some of those extra luxuries that maybe you were paying for before. Now, everybody's situation is different, Austin, right? I don't want to try to paint everybody in the same light here, but what I'm trying to say is that's something we're going to keep an eye on, but I'm not at this time overly worried about what may come in 2026 when it comes to the renewal market.
Yeah, I think before we wrap up here, I'll mention a couple things with that. Obviously, anybody that did get a mortgage 4 or 5 years ago, I guess it would have been, obviously stress test, they're probably qualified at 2% above their rate, or, whatever.
5.25, yeah.
Or 5.25, so probably that. So, realistically, people that got those numbers probably can afford to stay put, assuming that stress test was done. Maybe they're, reaping the benefits of that, 1.5 or 2% rate, and maybe that is going to 4 now. So they'll definitely feel that in the wallet. Their payments might be going up by a couple $100, depending on how big their mortgage is. Again, don't want to hey, if you have a $450,000 mortgage, this is the amount. No, if you want to know that stuff, call Cole, point blank. And we won't go into all those different details on here. But obviously the challenge is other things are more expensive. So if your mortgage payment goes up a couple $100, that's one thing. But with everything else also going up a couple $100 more, that's where people feel the squeeze. So I just wanted to note that. As well, if you are a first-time home buyer listening to this, we could not stress this enough. Open your first-time home buyer savings account ASAP. It takes a couple days to do. Again, if you open it before the end of the year, you get an extra $8,000 in contribution room, because again, you get the $8,000 for 2025, and then again, you will open up that more room, I guess, in 2026, as opposed to if you open it on January 1st, you've missed that window. So if you have not done that, do that right away. Last thing that I guess I'll mention as well that could throw some of this into the blender or surprise us, one of the notes we have, are we anticipating any policy changes or government incentives? Maybe. We can't answer that now. I know there's been talk of some GST stuff. Again, I don't want to go into details with that because it hasn't been formally brought forward or voted on or anything like that. So again, there might be some first-time homebuyer incentives that come out, or some other incentives or whatever in 2026 that could contribute to that. But those are just a couple quick notes before we wrap up here. Cool. Anything to add?
Yeah, you know what? One thing on what you just said about some maybe policy changes or incentives. So don't be surprised if we see more first-time homebuyer incentives come in, because as Austin and I have talked about, they're trying to move inventory, right? So they're trying to eat up, especially a lot of these pre-sale condos. So they've already put into a place a GST rebate, and I think that's what Austin was alluding to there. But ultimately, don't be surprised, because they want to get people into the market and they want to sell these homes, because it's not just that people need place to live. They also need developers to continue to make homes, because we're going to have people slow down on housing starts, which means new homes. And eventually we're going to have the same problem that we had before, where we don't have enough homes for the people that need them. So it's a bit of a catch-22 there, but they are going to continue to more than likely try to incentivize people to buy these homes, and they're going to try to make them as reasonably affordable as they can by offering different things to make it possible to get into these homes. And then one more thing I want to touch on, which would be, it's not a prediction per se, Austin, but it'd be really nice to see. So I think it was at the end of 2024, they changed the rules for insured mortgages. They changed the cap, right? We talked about that. It went from $1 million to $1.5 million, which is great, especially in greater Vancouver area, greater Toronto area, where places are more expensive and you need to have that bigger cap. And the reason they do that is so you don't have to have as big of a down payment in order to get in a home that goes over that $1 million threshold. So what I want to say here is we have another category. So we've got the insured mortgage side, we've got the uninsured mortgage side, and then we've got this middle category called insurable mortgages. And basically what that means is you've put 20% down. So you aren't, but you're buying something under $1 million. So you are insurable because of your price point, but you don't need insurance because you're over that 20% down payment. It would be really nice to see that threshold get pushed to the $1.5 million as well. That would be, I can honestly probably speak for every broker when I say this, that would be massive in terms of why that would help. It allows typically better interest rates in that area than if you don't have insurance. And it would be nice to see insurable and insured maximum purchase price be at the same level. There's some consideration there, and I won't go too much into that, but that is one thing that would be really good to see and would be an awesome thing to recap at the end of next year if it comes into place. So hopefully I can circle back on this one and that's something that we see. But anyways, just one last thing there that would be really helpful, I think, for a certain demographic that's looking to buy under that 1.5 million mark and wants access to some better interest rates. So yeah.
Sweet. Well, very well put. Another episode all done, guys. Again, thank you for joining us. If you're not subscribed, please make sure to do so. And if you thought that what we said was interesting, thank you. But also feel free to share it with a friend or family member. We would appreciate it. Adios. Take care, and we'll see you guys next week.
Thanks, guys.